Well, we had earnings from Anand Rathi and the revenues have jumped well over 30%. That is the same for the EPS as well. And of course, we spoke to the management about the company's earnings and also what we can expect going forward. This is a slice of that conversation. Listen in.
We are building a business which is relatively agnostic to the external environment. It is easier said than done because you are in the business of investing. Of course, some degree of tailwinds and headwinds happen. But if you look at the last 6 quarter results, we've been listed. This is our 9th quarter result after having been listed. The first 2 quarters I would discount because the base was too small. Any growths from the COVID year needs to be ignored. If I look at the 7 quarters which have gone by, other than the 2, which had a base effect, which I would like to ignore. The mean growth we have given is about 33.8 to be precise. The median growth we have given on those 7 quarters is also 33.8. And the standard deviation of the growth number on a quarterly basis is about 5%, which implies that the range of results on a year-on-year basis quarterly has been in a very tight range, and God has been kind. That's point 1. Point 2, if you look at our 7 quarter results, it looked like it has been a very uneventful 7 quarters. In the same 7 quarters, we have had a Nifty go from 18,500 in October 2021 to 15,200 twice. We have had a Ukraine war. We have had a inflation shock in the US and the steep interest rate increases resulting from those. So if you look at our results, it will look like a very, very calm water over the last 1.5, 2 years, but that's not been the case in the external environment. I'm just trying to prove the hypothesis that we are trying to build a business which is not only dependent on a tailwind coming, but it is from a client portfolio standpoint, whatever is right for them. If you do that, then you automatically build a business where in bad times, clients give you more money because they trust you more in bad times.
Interesting. So what differentiates you from competition? Because when you're looking at some of the AMC numbers, 34%, of course, nowhere close to that. So what's helping you stand out in the current market and in the current environment?
What helps us stand out is, the asset management companies, if I describe our business, they are similar businesses. They are alpha managers. We are beta managers for the client. Beta managers, by which I mean I do my asset allocation, manage the risk of the portfolio. If I have to use an asset management company's service to generate alpha or a benchmark, I use an asset management company. So that's the key differential between the 4 listed asset management companies and us. We are in the beta management business. They are in the alpha management business. That's one important difference. Second thing is we are in the H&I business, because to run this business ethically, you're going to be earning 1.25 to 1.3, 1.4% per annum. So if you have a smaller ticket client, it becomes difficult to give ethical advice without being biased. If there's 1 crore, then you're just earning 1.3 lakhs a year. And that's not good enough. So the average size of the client has to be really large if you're not just going to be a technology-led business. So what we believe is that you go into the H&I business. That's why we are in the H&I business in the primary company, which is the holding company. And that helps us give right advice, create portfolios, design those portfolios by testing 5,000 odd portfolios. We recommend only 3 portfolios to 4 portfolios. Those are very, very strongly back tested, even front tested using simulators, so that the outcomes are more predictable. So you're not over committing to a client, and we are always under committing and over delivering. Either it be the result or be it a client expectation with respect to the return risk profile we create for them in the form of portfolios.
Sure, fair point. But, there has been some amount of chatter in the industry with regard to fees coming down, with regard to both from an AMC standpoint as well as from an asset manager standpoint. Now, what are the risks of that from a regulatory standpoint, and what's the risk of that on your business specifically?
See, Harsh, of course, fees get compressed. Economies of scale needs to be passed on, is what the regulator rightly says, because mutual fund is a very transparent platform, and we are one of the largest distributors in the country. But we believe that in equity mutual fund, there's enough to add value. Because the best and the worst equity funds deliver 25, 27% return differential. So if you add value to a client in terms of a distributor doing the kind of research which is needed, so we have 122 research people. So there is a battery of people only doing mutual fund research, which is in the marketplace considered to be a very, very commoditized product. We analyzed about 1,600 HNI portfolios externally managed transaction-wise, and we've beaten 94% of those portfolios using our model portfolio. So if you add value, you will be able to protect your fee, one. Point two is, I think economies of scales can squeeze your margins by 5-10%, and that's very easy to mitigate. Last 7-8 years, the commissions have squeezed as well. Adversities happen in any business. It's about the capability of the professionals running that business, who could maneuver and traverse the path of uncertainties. I can surely tell you that there is going to be challenges thrown at any business. And if you look at the challenges we have navigated over the last 5-7 years, that should give some degree of confidence of how we react positively when there are challenges, and what kind of strategies we pre-plan before any of those knock on our doors.
Right, that's the management of Anand Rathi, well, giving us a very robust picture and some ambition, along with plans, what in fact could propel the company even further going in.